Hi, it's Charles Kelly, Money Tips again. Great to see you all. Today I have a very special guest, Lawrence Silver, who is an independent equity release advisor. Been in the business many, many years. Also a former financial advisor like myself. And it's great to have you, Lawrence. Welcome along today.
Oh, thank you for having me, Charles.
No problem at all. It's a pleasure. And I've met Lawrence through networking as well. So I know Lawrence now. And I, I'm interested in this equity release because it does help a lot of first-time buyers get onto the market. But a lot of people don't understand it. They see adverts on TV and they think, oh, you use it to buy a car or something like this, or a holiday. But Lawrence, maybe you could start from the beginning and explain what exactly is equity release.
Okay. Equity release is a mortgage arranged for people who are over 55 years of age as a first charge against your property. It's exactly the same as any other mortgage, which is a first charge, except that it's only available for people who are over 55. You do not have to make any repayments until you're dead or go into permanent long-term care, but you can repay the interest as you go along if you so wish.
Okay.
So that is basically what an equity release product is.
Okay, so you say first charge on the property. If there's a mortgage on there already, the equity release can be presumably used to pay that off, could it?
Yes, quite often we get people who have got interest-only mortgages,
Yes.
and they now have to repay the capital, which they don't have,
Yes.
and they will use equity release as a means to repay that capital. They can carry on paying the interest if they wish, or let the interest accrue, as I say, until they're dead.
Great. I mean, I do meet people like that. I meet people in their 50s, 55, 60, and they haven't paid that mortgage off, and their mortgage is coming to an expiry. It's actually expiring, and for some reason they just either didn't realize or just thought they would have it paid off. And this is a good solution for that, I think. And I also met somebody who has a Northern Rock mortgage that she can't even refinance, so
No,
it's a lot of people in difficult positions at the moment.
there are a number of lenders who have come out of the market a few years ago, Northern Rock being probably the most well known. And people want to make any changes, are not able to do so. There's no extra money available through Northern Rock, or the people who have taken over the Northern Rock portfolio. So yes, it is. We have arranged several instances where people have taken a Northern Rock, and then we've supplemented it and refinanced it at a later date, sometimes at a lower interest rate.
Okay, so it doesn't really matter what your income is, does it? Because with a mortgage, usually they're looking at your income. With equity release, they don't look at that, right?
Yeah, that is correct. The lender is not concerned about your income because you do not have to make any repayments as you go along. You can if you wish, but it's purely on a voluntary basis. Consequently, there is no reference to your income other than the fact they would do a credit check. And if you were an undischarged bankrupt or had major debts, they may think twice about it. But it's a much easier than just arranging an ordinary mortgage.
Right. So presumably because they're not doing income checks and the interest is rolling up, the loan to value is quite low. So they're not going to give you a 90% equity release, are they? So the loan
No,
to value is quite low.
that is correct. The loan to value is quite low, but it varies depending on your age. The older you are, the higher the loan to value. But even at its highest level, it's unlikely to be any more than, say, 50% of loan to value.
Okay, yeah, I get that. Obviously, because the interest is rolling up, and now we hear a lot about the bank of mum and dad, don't we? Where it's isn't it one in the top 15 lenders, the bank of mum and dad, where
The bank of mum and dad, apparently, I'm not sure how it's measured, but the Bank of Mum and Dad is allegedly the ninth largest mortgage lender in the country.
Okay, this is where people are either using their own savings, but generally it's taking money out of their house because, you know, a lot of baby boomers have bought houses when they were really cheap, paid off their mortgage years ago. And of course, they've gone up over 25, 30, 40 years, and they're sitting on a pile of equity, but you can't get it, that equity. You can't take it down to Tesco's and buy food or buy a holiday with it. So this is a way of releasing the equity through a mortgage. And then you can actually use that to help your children or grandchildren buy property, right?
It is very much so. Or even we've had cases where the grandparents are actually paying for the grandchildren's school fees.
Right.
And they pay for that on the equity release. The point being that the likely beneficiaries of your estate is going to be your children or your grandchildren. So they may as well have the money now when they need it, not in many years' time where maybe their need is not so great. It also helps the children get on the property ladder rather than wasting their money on rent.
Yeah, and I guess it reduces the value of the estate when it comes to dealing with inheritance tax. And apparently inheritance tax receipts are going up because more and more people are falling into it. They haven't increased the thresholds for a few years. So a lot of people could be paying inheritance tax. They always think inheritance tax is for the rich, but actually it's not. So
no, that's true.
This can reduce the value of your estate.
It can. I'm not an inheritance tax advisor, but it is a debt on the estate. And consequently, you're right that the inheritance tax is reduced. Also, the capital growth, if it's been passed to children, the capital growth is already outside the estate. So consequently, the capital growth itself is not linked to inheritance tax. The only thing you have to watch is the first 7 years of passing the gift could be subject to inheritance tax in the event of early death.
Okay. Well, having dealt with probate cases before, which can drag on for 2 years or more, it seems certainly easier if the person's just given the money to the beneficiaries rather than let the beneficiaries fight it out later on. It's quite a long, protracted exercise. So I think it seems like a great system to me, a great way of pulling money out. And you say it's for only age 55 and above.
Yes.
And is there any reason for that? Why do they pick that? 55?
Yes, I think this is intended. It's called a later life mortgage, and it is intended for older people. If you start too young, the build-up of the interest is going to be too great,
right?
In relation to the value of the property. There is always the two factors we need to consider is one, that you always own the property. The property is not owned by the lender. It's just like any other mortgage where you own the property 100%. And there's also a no negative equity guarantee, which means that you can never be in negative equity, which means that on your death, the estate would not have to stump up extra money to clear the mortgage.
Okay, and if you've got a couple buying, for instance, what happens then if one of them dies, 10 years down the road?
Right. The effect of the first death in a couple is minimal, really. Doesn't have to affect the issue at all. There are some companies, in fact, most providers, if there's the first death, they would allow you to pay off the mortgage without there being any penalty for a period of up to 3 years after the death.
Okay. So in your experience, do most people run these until they die or until they maybe downsize and go into a retirement village or something?
In my experience, most people just let the thing run. While they're doing it, it's heavily on their minds. Once it's done and dusted, they put it away and tend to, because they're not necessarily making any payments, so they just don't think about it. It's important that the children know that this has been done, so that they are aware of any situation that may occur in the event of their parents dying. But in the event of the first death, it can have minimal effect.
So do you tend to meet with the whole family then? Do you go and meet the people and tend to try and meet with the
We
family?
like to meet with the family. We would prefer to meet with the family because we don't want them to have any surprises. And from our point of view, we don't want any problems when the parents have died to get the children coming back. Oh, we didn't know anything about all this. We heavily recommend that the children or beneficiaries are notified, and we recommend that they attend any meetings that we may have before the deal is completed.
Okay. I don't know what the main reason is for equity release, but I've certainly met people that are sitting on a big property, a pile of money, but they can't afford to heat it. They've run out of money really, because there's a lot of people who haven't got much pension provision, and the state pension is only giving them a couple of £100 a week, maybe 800 a month, 900 a month, and they just can't afford to live. So do some people take this out to really fund their living, or maybe
particularly in the current financial situation, the cost of living being what it is, and with many people being on a fixed pension income, that they are, and as you rightly say, they're sitting on property worth a lot of money. So why not utilize it and lead a comfortable life and not have to worry and struggle about how they're going to heat or eat when they're sitting on a high value property. Even in areas where properties are not a particularly high value, you can still obtain some decent money coming out.
Yeah, and as you say, people are struggling at the moment. Maybe their house needs work doing to it. I also met someone who's sitting on money mostly in her bank, and of course we've had low interest rates, which has been great for borrowers, but not so good for people, savings, and their savings have been whittled away by low interest rates paid by the bank and high inflation. So that she is now, instead of living off interest, she's dipping into capital. Capital's going down, and eventually she's going to have to do something with her house, because that's the only money she's got left. She didn't do much private pension savings or anything like that. So,
we find that there's a lot of people, their capital is diminishing, and they're starting to worry about that.
Yeah,
they need to keep a certain amount of capital for emergency purposes. And they don't like the idea of not having. They like it, or I'll put it a different way. They like the idea of having money in the bank. So yes, they will raise some funds to help them on either big projects such as home improvements. They want new kitchen, new bathroom, etc., etc. Or for sometimes we get people coming to us with a shopping list of things that they want to do.
really.
I've just very recently had a case of a lady living in Twickenham who's inside the new zone, and their car is not compliant. So every time they take their car off the driveway, it costs them £12.50.
I know.
So they need to replace the car and haven't got the capital to do that. A personal loan at their age, in their 80s, is not very easy. So we raise the funds at an interest rate which is much lower than any personal loan anyway.
Well, that's quite a smart thing to do, because some of these cars can cost, new cars, £30,000-40,000, and why not have a decent car? If you've worked hard all your life, why not enjoy the rest of your life and not sit on this property and think, oh, I can't do anything with it. I'm going to leave it to the children or grandchildren. But in the meantime, you're sitting there shivering in the winter. It's just crazy.
It is. I can remember when I was a financial advisor years ago, we would talk to people about arranging pensions, and they would say, "Oh, my property is my pension."
Yes.
And now they're in a situation where their property needs to become their pension, and the money is there. That the situation is as a return, if you like, compared with the value of their property 20, 30 years ago, the return on their, in inverted commas, investment is quite high, probably more than they would have got, safe investment after all, than on pretty much anything else.
Okay, that's great, Laurence. So how do you go about arranging these? Do you go and see people, or do you talk to them initially, or do you go and have a chat with them?
Right. Normally we have a brief telephone conversation. I would have a brief telephone conversation just to get a little bit of background. On the basis that we're going to be able to help, then I would set up either a face, whichever on the client's preference, either a face-to-face meeting, which I prefer, and most clients prefer, but some people are happy to and want quite happy to do a Zoom meeting like we're doing now, and so we would have an initial chat. I fill out a fact find, which requires a lot of information about people, so we know all about their health and about their financial situation and their general background as to what and why they want the money. I would then go away, do the research, and come back to them maybe a week or two later with the recommendation. If they're happy to accept that, then we will fill out an application form, would be completed, submitted to the lender, and we take it from there.
Okay, so a couple of points there. You are regulated, right, by the
Yes,
FCA?
well, we are regulated. Yeah, we're regulated by the Financial Conduct Authority. We are members, or I personally am a member of the Equity Release Council. Sometimes there is a advice fee, but I'm tending not to charge an advice fee because we do receive a commission from the lender, and therefore I can offer the advice and put it all together without necessarily charging any fee at all. So apart from legal fees, just to say that apart from legal fees, there is not always any other fees. Some lenders have an arrangement fee, but otherwise, so the actual costs of setting it up are relatively low.
Okay, and you're independent. Sorry, is there a survey as well? Is there a survey fee?
Yeah, well, after two things there. Firstly, yes, I am totally independent personally. I have no tie-in with any particular provider. So of all the there's about 500 different plans on the market. Not a huge number of providers, but there's a plethora of schemes out there. It's my job to sift them. Yes, when the application is submitted to the lender, they will immediately initiate a survey, which is done for valuation purposes. It's not a structural survey, but obviously if the place is falling down or it's full of rising damp or dry rot or something, then the lender is not going to lend. And that's partly what a surveyor does, but it's not a deep structural survey.
So who covers
and it's free of charge. And it's free of charge. Most lenders will do that free of charge.
Okay, so your job is to assess the market, and you would give best advice based on which lender is offering the best deal, the best rate, and obviously will help them the most. And
yeah, also I think my job after it's all been submitted, my job is to I call it oiling the wheels, so that if there's any issues going on, and sometimes there could be some hold-ups or other unforeseen issues, always as often happens, then my job is to help and try and sort those out. And I find that creates a good relationship with the client and also gets things done quickly.
Okay, Lawrence. Well, anything else you wanted to add about this? I mean, I think we've covered most of it and what equity release is. And
okay, I think I need to point out that if people pay it off, it is a long-term contract. So people need to be aware that if they pay it off early, they could be hit with they may have to pay some kind of early repayment charge. That early repayment charge would be indicated before they signed up, so they would know what that early repayment charge.
What do you mean by early? Like 1 or 2 years?
Well, it varies from lender to lender. Some lenders are 5 years, 8 years, or 10 years. Okay. As time progresses, that early repayment charge reduces.
Okay, so this is a long-term.
So you do need to be aware that this is not meant as a short-term loan. It is meant as a long-term situation. There's no early repayment charge in the event of death, and there's no early repayment charge in the event of going into permanent long-term care. And there are other aspects of it too, but you need to think that if you just want to pay it off early, then you have to consider there might be an early repayment charge. So I think people need to know that. And the other thing is, I think people are aware is that they can repay the interest as they go along on a voluntary basis, so that there's no build-up over the years, and it becomes like an interest-only mortgage. And we do get quite a lot of people doing that.
Okay, and even I guess the children or the grandchildren they're helping to buy the property could also cover the interest, I guess.
Yeah, that does really happen. Yeah, that really does happen. We've many cases where people the rent is so high that even with new interest rates being at a much higher level, it's still cheaper from a cash flow point of view for the children to pay the interest, and even the interest on the equity release as well as their own interest. And of course, they've got the capital gain of the value of the property as time goes on. So it makes a lot of sense. And I don't think people actually think about that. I think they need to be aware of that it is a really useful tool for helping the children.
It is. And also with interest rates going up now, the affordability has been affected, and young people can't borrow as much as they could maybe a year or two ago because the interest rates are now higher. So they might need a bigger deposit to get the property they want. And getting out of the rental market and into a property is a big step for people. And it means they're no longer paying rent. They've got their own property. And as Lawrence said, even if they covered both interest rates, they would still be in pocket in most cases, depending on the size of the loan, obviously. So it's a good thing. I think it's a good thing all around for people.
Yeah. Really, what people need to do is have a chat, see whether it's for them. It's not for everybody, but there are a lot of people where it would suit greatly. Have a chat so we can see whether or not it suits, and if it does, then we can proceed.
Okay, well, certainly anybody that comes through this podcast, I hope Lawrence is not charging you a fee. That's
true.
I think the important thing is you can have a chat with Lawrence without worrying about incurring any costs. You're not going to charge for an initial chat, are you? So it's always worth talking to somebody like Lawrence who's independent. Whereas if you just go with somebody you see on TV, often they're selling one lender's products, whereas Lawrence can look at the whole market. Okay, that's great. Well, thanks very much, Lawrence, and we'll put your contact details up, or you can give your website now, but we will put your contact details up in the show notes. And if you need advice on that, either get in touch with us, get in touch with Lawrence, and I think it's well worth looking at.
Okay, thank you very much, Charles. Thanks for having me on your podcast. It was very enjoyable. Thank you.
Thank you. Thanks, Lawrence. Thanks for your time and good advice there. Thank you.